At Numerian Capital, we bring you the latest stock news each day. Please like and subscribe so we can bring these articles to you each day. Thank you.
Today, November 30th, 2022, Market Crash Alert. Mark your calendars for December 2nd. Markets anxious ahead of Friday's key jobs report. On Friday, the U.S. Bureau of Labor Statistics will release November's employment numbers. This will be the final data released prior to the all-important December Federal Reserve meeting. Strangely, most economists agree a slowdown in job growth would be a positive sign for the Fed's tightening efforts thus far this year. Market crash concerns are running hot ahead of a crucial jobs report this Friday that will likely set the tone for the Federal Reserve's upcoming rate hike decision. Payroll jobs are projected to have increased by about 200,000 in November, a notable deceleration compared to most of this year. Surprisingly, however, slowing job growth may well be exactly what most economists are hoping for. Inflation and unemployment tend to go hand in hand. Just this year, former Treasury Secretary Larry Summers stated we would need 1 year of 10% unemployment, or 5 years of 6% unemployment to bring inflation down to reasonable levels. The relationship between unemployment and inflation has some strange implications for this week's labor market reading. In a bizarre twist of fate, this month, bad is good, and good is bad. A weakening hiring market will send a signal that the Fed's tightening this year has begun to truly reverberate through the markets, potentially hinting at an impending drop in prices and, more importantly, a less drastic monetary response. Unemployment is a lagging economic indicator, a point exemplified in this year's relatively strong jobs reports. Indeed, for most of the year, despite industry-wide slowdowns, the country has added upwards of 400,000 jobs a month, not exactly reflective of the recession some economists claim the country is in the midst of. This time around, a softening jobs report would likely read as a strong sign that the Fed's efforts this year haven't been in vain, that inflation is already on the path downward. This could, in turn, nudge the Fed towards a milder rate hike in December, if they raise rates at all. The Fed rules the markets, data rules the Fed. Data reports on jobs and inflation have proven major market catalysts this year. Just this month, when October inflation came in just 0.2% under expectations, the S&P 500 enjoyed its strongest trading day in 2 years, climbing more than 5%. On the contrary, poor inflation reports only stoke fears of a market crash. This is, of course, in no small part due to their relevance to the Fed's monetary agenda. Friday's job report could be particularly strange in that a very good labor reading may actually push stocks down. Indeed, investors may opt to sell the news, understanding that strong job numbers would likely only strengthen the case for additional rate hikes. Conversely, should jobs numbers come in cooler than expected, investors may buy up equities, hoping for a reversal of the Fed's hawkish policies. Indeed, notions of a Fed pivot, the idea that some miracle data point will trigger the central bank into not only ceasing its rate hikes but lowering rates back down, have been floating around for much of the latter half of the year, much to the chagrin of Fed leadership. Indeed, just about every Fed spokesperson has hinted at additional rate hikes to come, including New York Fed President John Williams, who, just this week, outlined expectations for the central bank to maintain elevated interest rates for the next few years. Inflation is far too high, and persistently high inflation undermines the ability of our economy to perform at its full potential. I do see a point, probably in 2024, that will start bringing down nominal interest rates because inflation is coming down. Market crash fears heat up ahead of rate hike decision. The Fed has, for better or worse, been the focal point of the U.S. economy in 2022. From equity markets to mortgage rates, the central bank has touched virtually every aspect of this year's financial operations in significant ways. Throughout the year, the Fed has focused all of its monetary powers on lowering inflation, regardless of the potential consequences. With 2% inflation as the goal, the central bank has been relentless with its rate hikes. So far this year, the central bank has opted to raise rates 6 times, with the last 4 being massive, 75 basis point hikes. This is unprecedented by nearly any measure. The last time the Fed raised rates 75 basis points before this year was in 1994. When the benchmark rate increases, the entire economy feels it. As a result of the Fed's hawkish policy, 30-year fixed-rate mortgages have climbed to over 7% this year, previously trending around 3%. Meanwhile, 10-year Treasury yields have climbed from 1.5% to 3.7%. The stock market has also been quick to note the effect of the Fed's tightenings, with many companies reporting weaker than expected earnings straight off the back of higher borrowing costs. As such, inflation readings, like the Consumer Price Index and Personal Consumption Expenditures Price Index, alongside jobs reports, have carried substantial weight in the markets this year. Traders have been happy to panic buy or sell from even the most passé signals, meaning this Friday's jobs report could very well wipe away this week's losses entirely, or add to them. Friday's job report is set to be the final data release before the Fed's final Federal Open Market Committee meeting of the year, scheduled for December 13 to 14. Expect scrutiny, plenty of speculation, and just maybe, an unemployment-induced market rally, or market crash.
Thanks for watching Numerian Capital News. Please come back tomorrow for another stock news update. Thank you.